Welcome to On Course Financial, Charting Your Financial Future. This is the podcast for people who want clarity and confidence in their financial decisions. I'm Chris Brumlow. I'm a partner with the BAB Group. I'm a financial professional and an investment advisor representative, as well as retirement planning specialist. The BAB Group is a proactive accounting and wealth management firm focusing on individuals and small business owners to provide holistic advice when it comes to navigating their financial futures. We help those individuals and business owners understand their numbers, connect them to real decisions, and use them to plan for the future, not just react to the past. In our podcast, this is where we talk about the real intersection of business, taxes, retirement, and life planning. Each week, we focus on helping small business owners and individuals make clearer, more confident financial decisions without hype and without the guesswork. The information provided in this podcast is for general educational and informational purposes only and should not be construed as investment, tax, or legal advice. The views expressed are those of the host as of the date of this recording and are subject to change without notice. This podcast is not intended to provide specific financial recommendations or to serve as a substitute for individualized financial advice. Any references to tax strategies are general in nature and may not be appropriate for all individuals. You should consult with a qualified professional for your taxes and your specific situation. Investment advisory services are offered through AlphaStar, an SEC registered investment advisor. Registration with the Securities and Exchange Commission does not imply a certain level of skill or training. Past performance is not indicative of future results, and investing involves risk, including the possibility of the loss of principal. This podcast does not constitute an offer to sell or solicitation for an offer to buy any security. Most people think retirement planning is about how much they've saved. But from years of working with retirees and pre-retirees, I can tell you something important. What matters just as much is how much of that money you actually get to keep. Two people can retire with the exact same portfolio value, same investments, same market return, and one of them can run out of money years earlier, not because of the market, not because of bad investments, but because no one ever helped them plan for taxes. Today, we're going to talk about why tax planning is the missing link in most retirement plans and how fixing it can completely change the retirement experience. Welcome to On Course Financial, Charting Your Financial Future. This is the podcast for people who want clarity and confidence in their financial decisions. I'm Chris Brumlow. I'm a financial professional, an investment advisor representative, and a retirement planning specialist for the BAB Group. Each episode, we focus on the real issues that impact your money, taxes, income, timing, and the decisions that can either give you freedom or create unnecessary stress later in life. Let's start with how most retirement plans are actually built. For some people, and for most people, the focus has been on accumulation. How much am I saving? How is my portfolio performing? Am I on track to hit my number? And that approach makes sense, especially during your working years. But here is the issue. Most plans stop there. Taxes are often treated as something we'll deal with later. Industry research consistently shows that most Americans hold the majority of their retirement savings in tax-deferred accounts, like 401ks and traditional IRAs. That means a large portion of your retirement planning is focused on pre-tax growth, not after-tax income. And not accounting for that tax can create more exposure to your overall retirement nest egg. So while people may be doing a great job saving, they're often missing on how those dollars will actually be taxed when retirement begins. Now, for decades, people were told something very simple. I'll probably be in a lower tax bracket in retirement. And that idea was based on a different environment. Pensions were common. Tax rates were structured differently. Retirement income sources were more predictable. But today, retirement often includes multiple taxable income streams. Social Security, required minimum distributions, investment income, just to name a few. And here's an important fact that many people don't realize. Depending on the income levels and that provisional income that the IRS keeps up with to determine Social Security taxation, up to 85% of your Social Security benefits can be taxable. Now, that surprises a lot of retirees. Add to that the reality that future tax rates are uncertain at best due to national debt levels, entitlement funding pressures, and longer life expectancies. The old assumption of lower taxes later becomes less reliable. This doesn't mean taxes will absolutely go up. It means that tax rate risk exists, and ignoring that risk doesn't make it disappear. For many retirees, the tax problem doesn't fully show up until their 70s. That's when a thing called required minimum distributions, or RMDs, begin. Under current law, most retirees must start taking required minimum distributions at age 73. These distributions are mandatory and they're taxed as ordinary income. And you don't get to choose whether or not you get to take them, whether you need it or not. For most people who've accumulated large balances in tax deferred accounts, RMDs can create income spikes that they never planned for. And those spikes can trigger higher tax brackets, more Social Security taxation, and higher Medicare premiums. This is often the moment retirees say, I didn't realize this was coming. Let's talk about something else that catches people off guard: Medicare premiums. Medicare is not a flat cost program. Premiums are means tested. This means that higher income can reduce in higher Medicare Part B and Part D premiums through what's called IRMAA, income related monthly adjustment amounts. Here's the key detail that most people miss. ARMA is based on your income from the prior 2 years. So decisions like large RMDs, Roth conversions, or capital gains can quietly increase healthcare costs later. Even if nothing changed in your life at the time, in retirement, taxes don't always show up as a line item on your tax return. Sometimes they show up as higher monthly premium. One of the most important concepts in retirement planning is tax location. What do I mean by that? It's where your money or your retirement assets are stored. Out of all the investments that exist out there, there are really three basic tax locations or storage for your income in retirement. And that's taxable accounts, tax deferred accounts, and tax advantaged or tax free accounts. Two portfolios with the same total value can produce dramatically different after tax income, simply based on how these assets are positioned across these categories. When all of your money is in one tax bucket, you lose flexibility. When you have money in multiple taxable locations, you gain control. Control over income, control over tax brackets, control over timing. It's not just about how much money you have. It's about where that money lives and how it comes out. Now, there's an important distinction between tax planning and tax preparation. Tax preparation is historical. It looks backwards. This is what you had earned income. This is how much taxes you pay. It reports on what has already happened. Tax planning, on the other hand, looks forward. It asks, which account should I draw income from this year? In which order? Should Roth conversions be done while tax rates are lower? How do we avoid pushing income higher in later years? How do we smooth taxes over time instead of stacking them earlier? Good tax planning doesn't require taking more investment risk. It's about coordination, timing, and the intentional decision making. Your tax return tells you what happens. A tax plan helps you determine what should happen next. Now, I've seen this play out over and over. People who did everything right, they saved consistently, they invested responsibly, and still they feel boxed in during retirement. Not because they didn't save enough, but because every financial decision triggers taxes. On the other hand, when tax planning is integrated early, income becomes more predictable, stress goes down, flexibility increases, and retirement becomes less about managing surprises and more about enjoying the life that you've worked so hard to build. If there's one key takeaway from this today, it's this: taxes are one of the largest controllable risks in retirement. Ignoring tax strategy doesn't eliminate taxes, it often concentrates them later when flexibility is lowest. A retirement plan without tax planning isn't broken, it's unfinished. Now, in our next episode, we'll talk about tax rate risk and why uncertainty around future tax rates may be one of the biggest threats to your retirement income and what proactive planning can do about that. Thank you for listening. I'm Chris Brumlow, and this is On Course Financial, charting your financial future. Have a great day.